before they come and speak to us as well. So a lot of that I start performing why. So really around why you're buying, what are you trying to achieve, and who are you buying for? Because it does change across. We see with a lot of doctors and trainers, it does change. Some doctors come through and are single at that point in their life and just want to buy somewhere to live. Some of them want to buy an investment property just to get into the market. Some of them have families already and are buying for their family. So actually, these questions are very, very relevant because it will change what you're looking for in the market, what you want to buy, which takes us over to what you want to buy. So are we looking at buying a house, a unit? Are we looking at buying land or not the plan purchase, which I will speak about a little bit more later? Or are we in an area where we're looking for a new build? Especially say down through the southwest corridor of Sydney and in the northwestern zones as well, new building is right. So are these the sorts of things, and does that match the why we're buying? Moving on to how, so things like, do we have savings to complete the transaction? What incentives are available to me? Can I afford the one? So how much can I actually borrow? And who should I be doing this with as well? So there's sort of how are we actually going to achieve this? So we know we want something, we know what we want now, how are we going to actually achieve it? The other one is who's buying the property? So this is where you start to, and we'll go through in a few pages as well, the important people in the process. This is where we start talking to people around what are we actually buying the property for? So if we're buying it as an investment, are we buying it just in, is it better bought just in your name? Is it better bought in a spouse's name? Is it better bought together? Is it your home? And is it better bought together? These are the sorts of things that we start to have a look at. So I've written on there, are you buying it on your own or with somebody? What implications is this going to have? Who will actually be living in the property? These sorts of things will drive your decision making around how you set that up, but also that decision making will be assisted through a core group of people, which I'll speak about a bit later as well. And where? So the other one that I like people to have a think about is I speak to a lot of doctors and training and sit there and go, look, I may be here for 2 years, and then I may go into state, or I might be positioned out rurally, or all these things could potentially change, or I don't want to be in this area, or I'd like to be in another area of Sydney or another area of New South Wales, etc. So where are you going to be working? Are you going to be working long term in this location? What's important to you, and what makes this property attractive? And the reason I ask these questions are, if you're buying this property now, is the intention of it to be an investment property long term, as opposed to your actual home? And a lot of people answer yes to that, because obviously they're going to my house for now, but it's not my final house. And I would like to, like most of us do, I would like to keep this house and buy my next one and start building up a portfolio. So what I make people have to think about is, when you're buying that property, that's fine, but a lot of people get caught up into the trap of, this one's cheap, and the rent's okay. So fantastic, but what they haven't considered is the property isn't set up for anyone, maybe rather than yourself. So what I'm suggesting here is, when you're buying a place, you always think about what the future market is. So is it in an area that is growing, that is near transport, that has a genuine growth need in that area? Is the property attractive? Is it 1 bedroom, 2 bedroom? Is that what people are looking for in that area? Would it be easily rentable today? And would you expect it to be in the future? And the easiest question to answer there most of the time is, if you sit there and go, I would happily live here for a long time, chances are most people would. The one thing to be careful not to get caught out on is going for a property where you sit there and go, look, this has a specific kind of person that would live in this property, because you may actually be limiting future sale or future rental by doing things like that. So I guess the gist of that is really looking at the fundamentals behind what creates good properties long term. And first of all, just good quality properties in good locations with access to quality amenities and transport, all the things you'll need. And these are the sort of properties that long term will do good for you in the market, or will do as good as they can possibly do in the market. So these are all the things that I encourage people to start thinking of, because it starts to then create what this first property that we're buying, what it might be your first home to live in. How are we actually thinking about it, and what are we going to actually buy? So then moving on to the next slide. Just to get this out of the way at the start, everybody always likes to see. I encourage encourage everybody to go and have a look. I'll put a huge warning up at the top of it saying, please check your situation with your conveyancer or solicitor because you may or may not be in these brackets. So always check what you have access to. And to be fair, if it's there for you, everybody else is taking advantage of it. So don't miss out. If you qualify for these, grab a hold of them because it's more money in your pocket. So in New South Wales, the first home buyer assistance scheme is around, and for a first home buyer you may be eligible for transfer duty concession or exemption. If your home is valued at less than 650, you can apply for a full exemption, which means you don't have to pay transfer duty. If your home is between 650 to 800, you can have a concessional rate of duty, so it starts to dial up from there, and then over 800, then it moves on to normal rates for you. For new homes in New South Wales as well, there's $10,000 grant for new homes that are no more than $600,000, or buying houses that is no more than $750. But again, check these out on what you're looking at. If your conveyancer tells you they're available to you, fantastic. I've made some notes there at the ACT as well. There's a few people who've been up between the ACT and New South Wales, but they have owner-occupier duty concessions as well. Please check those out. And they are for, that's basically, again, no stamp duty or stamp duty reduction between certain limits. And federal, so just be wary at the moment. Everybody's probably seen this in the news. The federal home builder grant, $25,000 for new home builds, less than $750,000, or substantial renovations that are between 150 and 750, and contracted prior to the 31st of December this year, and work commencing within 3 months of the contract date. Please note though, there is earning capacity and asset size test on this. So again, have your conveyancer, your solicitor check these out for you, and let you know which ones are applicable. But please be wary that they are out there, don't miss them, because these are, again, a leg up for you guys to get into the market. Moving on to the next one, this is just a very general note, but a couple of things that I see people missing out on here. The main people that I see in the first home buying market who are the real advisors, but really a financial advisor. So if you have a financial advisor who's helping you with these sorts of things, or done your insurances and all of this, they can give you a bit of guidance, and they probably have around budgeting and all those sorts of things as well. Your accountant, always your accountant. They know your situation. They have a very good general understanding of the market as well, and of what you should and shouldn't do. And they are a trusted advisor for most people. The bank or mortgage broker. So the reason I say that is people often take one of two routes. One is they go straight to, I want to be with this bank, so I'm going to walk into the branch and sort it out. Or they engage a mortgage broker. Like our services, where we go to market on behalf of them to look across best rates, best products, etc. As well. So the fourth one, it's not an interesting one, buyer's agent. Now, I do believe in buyer's agents because it becomes somebody working for you, not whereas the reason I haven't got a real estate agent on here is you're not the one paying the real estate agent. It's coming from the earnings of the sale. So the real estate agent is driven for the vendor, not for you. So the buyer's agent is actually on your side to go out there. Now, I will put a caveat on this. Buyer's agents do cost money, they're not for free. And where I find them good is that if you have the money to spend on them, they can go to market and find you a good property, one that you may not have found yourself. And they'll source out, and they'll also help you with what properties are good and not good with regard to some of the fundamentals and things that we've spoken about. The one caveat that I put to it is, because they cost money, if you're running a fine line on your deposit, they may not work. You may be between $5,000 and $10,000 on them, and if you're scratching for dollars to get your deposit together, it may end up being an unrealistic expense for you. So just be wary of that. But I do think their services are warranted. And the fifth one is your conveyancer and solicitor. Always trust in them around. They are helping you through this process. The one thing I find is usually people engage them once they've found a house. I'd be suggesting that you sort of understand your position and be looking for that person prior to buying, because you need to know, you need to be switching into, okay, I want to buy this, who am I going to use, who am I going to trust, have I spoken to them before, rather than, okay, I'm going to go ahead with this and I don't know what I'm going to do, I don't know who I'm going to do, who I'm going to go with, and you start asking around parents, asks, all of these sorts of things, which is fine, but better done earlier on in the piece. so that you're aware. So moving on to the next slide there. So this is just one thing that I like to bring up around borrowing as a medical professional. So you're probably aware, you probably have this putting in place all the time, but medical policies do exist and they are attractive to first home buyers. And in the market at the moment, there are 95% loan to value ratios going on. There was, but you need to be wary of this during COVID as well. There was opportunities to get to 100%. I'll talk about that a bit later. But some of the lenders at the moment are restricting their loan to value ratio, so it is important to have a discussion around who is in and out of the market. There are policies out there that will treat, so for example, say your second year, that will treat your income base as if you're a fourth year. It will take 2 years ahead of your current levels. So just be wary of that because that can help you to step up into that, maybe that next bracket. You might think that, what I want to buy is good, but I wish I could just have, $50,000 more to get into that next bracket of housing. It is possible. So just understanding who's out there and doing that may work for you, and understanding having somebody who's working for you through the market to sit there and go, okay, we know where you can go to get these levels of lending. There are favourable discounts, the standard and variable rates at the moment. So just being wary of that because the way that they work, most of the banks will work on what they call standard variable, and then they'll provide a discount, a license or low discount. You want to be maximising that position because they will apply to the loan for the life of it. So you want to maximise that discount so that you're always a large amount under standard variable rate. And with all of these, being medical, and the reason we talk about these 95s, because most people can walk into a bank and ask for a 95% loan, but they have to pay lenders mortgage insurance. With medical, lenders mortgage insurance is not a requirement. However, you may notice a few that have separate requirements, maybe around how quickly you repay the loan, or maybe have life and income protection in place. Just be wary of that. But the fact that you're not giving away, a lot of us see that lenders mortgage insurance is dead money because effectively you're paying an insurance policy for the bank to be protected. So we try to, where possible, we try to avoid that. The other things to consider are just basic things around lending. Are you doing interest only or principal and interest repayment? And just having a think around those. Most people for their homes will be aiming up at principal and interest and paying back. And in such a low interest rate environment, not a terrible idea at all. Do you want to do fixed rates or variable rates? At the moment, we're in a really interesting position where fixed rates are considerably less than variable rates. So always worth having a look at. But again, while the fixed rates are lower, there are pitfalls that come with that structure. And being able to talk through and understand if I take a fixed rate, how may that affect me going forward, especially if you have the capability of saving a lot of money. Do you need other options such as offsets and redraws attached? Yes, these things are wonderful attachments to products to have, but only when they're used properly as well. So is it applicable to me, and how do I use them? And also, one thing that I think people miss a lot on, they go for a rate, but what level of service am I actually going to receive once my loan settles? So how hard is it? Do I have to sit on the phone for an hour every time I want to talk to the bank? So just mixed in with who you're dealing with and how am I going to manage this ongoing? How easy is it going to be for me if I want to make changes, if I want to go buy another property? Those sorts of things. Those are the things that we look at as well around how you're going to be looked after. I made a comment at the bottom, but be wary. The current bank environment lead times are very long at the moment, and you need to be ahead of the game in pre-approval. So it's very hard when people come up to us and they have the property that they want, but they haven't gone and found funding first of all. So it's always better to get a pre-approval in place for yourself so you understand where you are in the market and what you can borrow, and then have a look in the market. And then the last thing really that you need to go through is getting that valuation. And sorting that out as well, and also getting through the settlement. Most settlement periods for houses when you're out there looking are around 6 weeks or 42 days. It is possible to have shorter, it is possible to have longer, depending on what agreements are in place. As a standard, you can call on 42, the default is to go to 42 days. But people can ask to stay 12 weeks if they know that they need to stay in that house and move out and you have no issues with them staying there. these things can be negotiated. Moving on to the next slide, just want to call this out. People miss this sometimes. Parental guarantee. So parents can provide assistance to their children with security and help funding required to purchase. Now, this can be, it needs to be somebody very close to you. It doesn't just need to be, they have extended rules out to whether it's a brother or a sibling or those things. Well, that person needs to be a very, very close relative for thanks to entertainment. The guarantee is provided not for services. So the guarantee is not, they do not take, say, mum and dad in to say, oh, now you can afford a lot more. They still base it on your servicing, but they allow a guarantee based on an asset. So this guarantee is secured by the parent's security property and limited to the portion of the debt that is over and above the bank's lending limit for the borrower. This can allow the borrower to achieve a higher borrowing LVR or loan to value ratio to replace the need for a larger deposit or paying lender's mortgage insurance. This works very well with in scenarios whereby the borrower's earning capacity is strong but has not had time to generate enough money for the deposit. Now, we find that all the time in the medical world where people have studied for a very long time, built up a large extent as well, however, haven't had the time to generate the deposit that they need. So to give you an example on the page there, Rob said there's a purchase of $500,000 and the person only has $5,000 for their name, which is realistically, I've written beside it, is enough to cover costs on the assumption that the stamp duty is waived as well. So the bank's offering a 90% medical policy. That means they're lending at $450,000 and providing a shortfall of $50,000 to finalise the purchase. The parents are holding an unencumbered home worth $300,000, which they're willing to offer as security. The bank will be looking to take a guarantee from them that's limited to $50,000, which will cover the shortfall portion. So now the loan has been achieved at $500,000, which is actually 100% of the property value. And it's at normal rates in the market. And what effectively you see people do is they will hold this position until such time as they can pay the debt down, or that the property is worth enough when revalued that is below, say for example, that the bank is at 90%, that this property is then below that part, and the parent's guarantee can be removed and the property handed back. It's important to note the two most important things out of that is one is parent servicing is not considered at all. So it is not a way of increasing the person's ability to borrow more money on the basis of capacity to repay. It is only a way to increase on capacity for the security portion if the borrower can afford that much. And it allows people to get in, into the market quickly from that position. So that's also, the other thing as well is the parent guarantee is limited to $50,000, not the whole loan. So they are only ever exposed, and that property is only ever exposed to that $50,000. But does work, and we do see a lot of those in the market. The general tips I've got at the end is get your team ready. So the people I spoke about before, the accountant, advisor, mortgage broker, a conveyancer or solicitor, buyer's agent these days. Make sure that you know who they are, who you want to use, and getting your team ready so that by the time you're ready to purchase, it becomes less of a chore. You're not running around trying to, at the last minute, trying to work out who you're going to use, and you've already had the time to consider that. The second tip I have is understand your personal budget. So understand your position, how much per month that you can put away and or invest into this property as repayment. Or maybe a little bit more than that. So if you're paying it off, maybe you want to be more aggressive. But understand your personal budget. And you'll understand that because you'll probably be trying to save money as well. So you'll understand what you can generate per month and put away. The reason I say that is there's a difference between what people show for what they can, for what the calculators say can afford versus what you say you can afford each month. And sometimes it's more you believe you can afford more than what the calculators show because they're a little bit harsh, and that's the way that they are. But sometimes it's the other way around, and that may be if you have some large personal expenses that goes on as well that maybe not captured. So just be wary of that. because it comes back to if someone says, you know, that the calculator is saying you can afford something that has $2,000 repayment per month, and you know you can only afford 1,500, then that's sort of something that you need to be wary of and limiting yourself to what you can afford so that you're not putting yourself under any undue stress as well. The third one is to think long term, and that really relates to what you're doing with this property and what you're going to do to achieve long-term growth out of it. So in the property you're picking, what is it going to be used for investment in the future? Is it going to be sold in the future? So think long-term around the areas you're buying in, the property you're buying, what you're doing, the structure you're putting it into, because that will help you long-term not have to change anything in the future or incur any other costs. Understand the structures of your loans. So the reason I say this, for two reasons. Understand if you're fixed or variable, what does that mean? How does that impact you? If you're using, so for example, a lot of you may see some of the lenders in the market that previously say offered 100% finance. However, understand how that finance is structured, because it may have a far more aggressive repayment profile than a standard loan. So just be wary of that. Now, the thing is, you'll be paying some of the loan back, but also be wary of how much is going out the door every month and what does that do to your overall budget and cash flow that you expect, because you may be saving for a holiday and things like that as well. So just be wary of those things. The fifth one I call on here is be wary of off the plan in the current market. What my real question here is, what will the property be worth by the time you're ready to move in? And the reason I say this is, if you only have enough money for your deposit, and let's for example say the property is $500,000, and you know by the time settlement's around or beforehand that you've got the $50,000 that you need, plus a little bit extra just for cost, and the bank will give you 90%. If that valuation comes in at $450,000, the bank will only lend you 90% of that, which is now $405,000. So now you've $95,000 that you need to find to put into that. Otherwise, you may default on the position and collapse the contract. Now, if that happens, you don't get your money back. The developers and builders will have access to keeping your deposit. So just be wary of those, that you understand what you're getting yourself into, and what can potentially happen if the market moves negatively against you. And do you have, or are you in that time, do you feel you have enough time to save up and create a buffer so that won't happen? Otherwise, the alternative is to look to buy in the market, live in the market, and then can have valued in the market, and you'll understand your position day one instead of say waiting 18 months. It just, in this current market, it may go either way on you. Obviously, with everything that's going on, it's just probably a risk that myself personally, I would look to take, and I just like to call out for people to think about before they do that for themselves as well. And obviously, I think to ask your financial advisor, your accountant, your mortgage broker, all those sorts of things, but just have a think about those ones off the plan. Just scare me a little bit at the moment. And then the last thing, which probably is a great segue into the next part of our chat, is, have you thought about what you would do if something happened to you? Now, that's probably a probing question leading into, are you comfortable with the position you're currently in around what you hold, your protections in place, if something was to happen to you? Maybe far more relevant to you if you have a small family than if you're single, those sorts of things. But that's Dave from my office will go through these and we'll have a chat about those, just so you're aware of what's available to you and what may or may not be important to you at this time as well. So guys, thank you. That's all the first time guys. If there's any questions, on the end, on the last slide, I've got the phone number and email address. Andrew, I know you have my number and email as well, so welcome to you to give those out to anyone if anybody wants to call and discuss or go through any ideas. But I'll go through from here, if you don't mind. We'll bring up David's insurance.
Sounds good. Let me just switch up the slides.
Hey guys, it's David here. Can you hear me?
Yes.
Yeah.
Awesome. Okay. One sec, Dave. We'll make sure it's live.
It's pretty cool.
Yeah. Wait, I think I just need to switch up the. What is this?
Guys, does anyone have any questions in the room while they're changing over from my stuff? We may as well look up that before we move into David.
Is this how it choose? I think my main question is about if you can tell us anything that you know about what might change going forward for income protection insurance. Like I'm kind of mildly aware of what changed earlier in the year, and I think I heard at that time that there were more changes coming, so I guess I haven't really thought about it since then. But
yeah, that's right. I'll get Dave will go through that in the next packet slide.
Yeah.
And he'll go through that, but if it's not directly answered there, we'll cover that off.
Yep.
Probably best we go through that first. So that he can cover off it. Yeah, there was definitely, so from my point of view, there was definitely changes around what's called agreed value, which you're probably aware of at the start of the year. And yeah, it's an ever evolving position, so it's good to be able to keep people up to date on where that's heading. I think Dave will probably tell you there's probably things that we probably still don't know yet on where it's heading, but he'll be able to give you a bit of advice there on where he sees the world going.
Yep. Thanks.
Slides are up, so whenever you're ready.
Okay guys, I'll just start again with the disclaimer, just so you guys know, the information that will be contained, it's just going to be general information and won't constitute any personal financial advice, as we haven't taken into account any of your personal financial objectives. Now, as Chris was saying, being life insurance, the main purpose here is to provide protection, be that if you're single, starting a family, or you have got a family. Now, I'll quickly just run through who we are and what sort of services we offer. We're a firm that specialises in financial advice exclusively to the medical, dental and veterinarian professionals. We pride ourselves on the service where clients are achieving the financial freedom which they seek. Within the team, we've had many years of experience working within these occupations, being medical, dental, veterinary and other professional clients. We're also the preferred provider for the AMA, ACT and New South Wales, and we also understand the importance of helping identify what your future goals would be and work with you guys to establish a clear and realistic path on how to achieve this. Now, how we do this, it's the same way you guys would operate. We function as a team of specialists, which will work together to find a suitable treatment plan for your common goals. Now, in saying that, we use for our investments, we've got a partnership with Bell Partner, who would be your specific investment advisor. You've got Catherine, who some of you may have met before. She would be the specialist in estate planning, for instance, where you come to myself for any life insurance queries.
Yeah, so just a couple of things in mind. That's probably one of our many, one of our larger, but one thing we pride ourselves on is the ability to have a very holistic view of your situation, but across the market as well. So not be restricted into one product offering. That's across lending and across financial service products as well. So very good, Dave.
Yeah, for sure. Now, what we generally do is for anyone that would be interested in obtaining life insurance or feels the need to, so that you've just bought a recent house or incurred any other sort of large debt you may wish to look out for. Now, if you could click over to the fourth page of the slide, what we generally would do is, if you had never been around life insurance nor had any experiences, so what we would generally start with is running a client needs analysis. So what this does is pretty much gives us a good idea on your current level of debt, your current lifestyle costs, any future wishes, plans, preferences. If you've got children, potentially, you have to look after the school fees. So it's our role there to calculate the appropriate level of cover to each and every one of you, depending on what your individual circumstances would be. We're specialist wealth. We do have access to the complete market for comparison. I've just listed a few of the main companies down in that list. You may recognise some, may not. We can pretty much assess what you've got, and if it does work out to be that you're sitting on the best product and that suits you down to a T, we will advise that. We're not going to push you guys just to get onto the new height, so to speak, or a new product comes out, let's push everyone across to this product, so to speak. we're here just to look out. So whatever's going to suit you, we'll find that one for you.
The way Dave and the team run it is that it's very important that we look at the person's situation and what they actually need to achieve from it. So in some cases, it's often that clients don't need insurance, or they do need it, but in specific areas. And it's odd. Sometimes I've seen this last week we had a client who we advised that they didn't require any more than just a small insurance policy, and they thought for themselves, they thought I need to be insured for a lot more, but when you actually unpack the position, they didn't need to be, and they were comfortable with that, which was quite funny, because you sit there and imagine people going out and going, do you want to take it? Let's take it. Let's write the biggest policy you can. But it's really about tailoring everybody to what fits their circumstances and what achieves what their long-term goal is.
And understanding what you've got at current, and a lot of clients who come in don't actually realise that they do have the life insured levels actually sitting under their super fund, for instance, and that is quite sufficient at that stage of life. It's just those things. We can do a review and make sure that you're sitting in the right spot as per what sort of risk that you're carrying at your current stage of life. Now, I'm going to lead into what sort of products we have. You've got your life cover, total and permanent disability, otherwise known as CPD insurance. You've got your trauma insurance and income protection insurance. Life cover is pretty much a lump sum when you die. Now, this will also pay out in the event of terminal illness if you're signed off with 2 doctors with 14 days left to live. Now, majority of clients choose to get this cover. It's mainly to clear debt, mortgages, and allow for future funding for education for your children. The level of cover can be quite unique depending on where you're at in life, what debts you may have incurred at that point. So we do suggest it's worth having a look at, because you'll find that most of you guys will actually even have a default amount sitting on your super fund, or you may even have an old retail policy which you might not have looked at. A lot of the industry funds will just offer a default amount, generally about 240 up to about 300,000, depending on which fund that you're with. Now, this may not be enough for what you need as a doctor, I find. It may just be enough to cover a quarter of it. So this is where we can review and check to see all your existing cover, just to give you guys the peace of mind that you've got the right amount in place. If you were to pass, your family's not going to be left with this debt or mortgage to have to repay. The next insurance that you generally would find is called the TPD insurance, total and permanent disability cover. Now, pretty much this one pays you a lump sum, and it's to help with the rehabilitation and living costs incurred. There's 2 definitions which you want to be wary of. The one I would watch for mostly is called any occupation. Now, this will pay you on any sort of job type that you can be retrained to work in. So if you're working as a surgeon and you injured your hands, for instance, they might say that you can still be retrained into a consultant role working on a phone to a call centre and not pay out. So the claims wording on any occupation is a lot stricter than what the office is. So the other one I would say offer is called own occupation. Now, this one will pay if you can demonstrate that you cannot work in your own specific occupation. So for doctors and specialists, this definition is important, because if you were to injure your hands again, that's you not being able to do your job as a surgeon, and then they would therefore pay out the claim. Whereas if you were on the one I talked about prior, being any occupation, they then have the recourse to come back and say, no, you've still got the relevant skills and ability to work in the call centre. We're not going to pay that out until you hit a definition of release. So generally you have to be bedridden, or have lost one of your arms, lost your vision. It's going to be quite severe before you can meet that condition of payment. So generally, it's one thing I would suggest to look at is to find out what occupation you have been listed as, because that may affect a claim in the future when you least expect it. That's probably one of the main points to worry about with the TPD insurance. Now, I'll just move on to critical illness insurance, which is otherwise known as trauma insurance, or in South Africa, the dreaded disease cover. Now, what this cover is, it's designed to pay you a lump sum in the event of a critical illness. It's around 60 conditions. So it's mainly such as Alzheimer's disease, motor neuron, severe burns, cancers, new strokes, loss of limbs, and many more. This one is mainly designed to help pay for out-of-pocket medical costs, living expenses for you and your family while you're unable to work, the cost of therapy, nursing care, special transport, any changes to your housing if needed, and paying back of debt, for example, a mortgage. So quite in regards, in comparisons to TPD, the claim time is significantly short. It can take up to 6 months sometimes on the TPD claim to get through the progress. But this one, once you hit one of their specified medical conditions relief, they have to pay out the money at that time. When you do hit one of those, say you've had a heart attack and you get paid out, you can still retain the policy. It's just that you can't claim on having another heart attack again in the future. So it will retain those other specified medical conditions off your cover. Now, to decide when you need to use this, you mainly want to just have a thought, how much income would you or your family need if you couldn't work for some real amount of time? If you haven't had any income protection insurance in place or any TPD insurance, then you'd also want to potentially consider raising up the sum to a future on insurance. Now, if you need to have any help deciding on levels of cover, just get in touch with one of the funds providers so we can help out with that. Generally, it's fine that you try and cover off what the cost of a cancer treatment is, but we can help work through those numbers. Now, the next form of insurances, which there was a question on earlier, is the income protection insurance. Now, the design of this product is to help replace your earnings when you can't work due to a sickness or an injury. So you'll be getting an ongoing monthly benefit, and that'll insure you up to 75% of your pre-disability income. Now, it's used for replacing income and supporting of ongoing living expenses. You can also, protect yourself against needle stick injuries with a built-in lump sum payment. Now, majority of conditions claimed at the moment is mental health, stress, anxiety, and depression, followed by musculoskeletal conditions. Now, with some of the changes, I'll just take note of, they have moved away from an old product which they had an agreed benefit which was payable. That's no longer available. You can now, due to substantial losses within the insurer market area, they've lost billions of dollars. The APRAs now have to actually put a foot in and say, look, this is enough. You can't sustain this anymore. You're no longer allowed to offer an agreed value product up to age 65. So that's no longer available. They can only now offer an indemnity policy. So what it means is you just got to have proved that you have worked for that level of remuneration for the prior year, whereas before you'd agreed from signing up for, say, $10,000 a month, you were agreed to be paid $10,000 a month until you were age 65. Now they have the option to review that and look at your last year's pre-disability earnings and pay you 75% of that. They can also now, every 5 years, they're looking at being able to underwrite the process. I think that's where the changes are still coming. To answer one of your questions, there's still going to be a lot more changes as to what they're allowed to re-question, re-underwrite, and alter in between those 5-year review periods. I don't know at the moment if there's going to have any further changes, but there has been talk that they're potentially going to focus further on income protection and the sustainability of the actual product in the marketplace. But as soon as they do, we can organise another training guide to run everyone through any new changes that are involved with that product.
Yeah, I think some of the main things that I've been reading is that they are looking to track back to current incomes, rather than, so to look to support people for their current income levels rather than looking to track people on the predefined position. So the ability to review that, I agree that the ability to review, say, every 5 years would be something that would be, make it a little bit more difficult in the future.
Yeah. So there's things such as smoking as well, like at current, if you were to disclose that you weren't a smoker and took out your application, put it in force, a year later you decide to start smoking cigars, for instance, at current, that's not a problem in the world. They would still pay you out as a non-smoker. I believe that they're starting to look into that, so that they can ask that question now, and then if that is a problem, then they can then increase premiums to cover that risk that would be involved. So trying to make sure they have a fair coverage of any risk they have to cover for.
Yeah, absolutely. And some of the work that was done in the background, so as David said before, some of the actuaries that are out there working on some of these long-term numbers shows that within a 5 to 10 year period, the whole industry would have imploded on itself if it was unsustainable. So that's why, unfortunately, even if it was a sustainable model, they would have kept them. They didn't just do it. They did it because the model long-term was never going to work. And if you're looking at insurances and those sorts of things, it's not the kind of thing where you want to go in thinking that the company's going to fall over in a few years. So it did have to be those. So, yeah, you don't want to be buying a contract that's just going to fold and not get paid out for. So it's correct. Find a way to save it and still have a price offering for people that can still, cover some debt where needed. Correct. I put some data in regards to some of the claims, what's happened in last year. The life insurance industry last year paid $12 billion out to roughly 100,000 Australians. Death cover having the most, of course, and the top call has been cancer at about 43%. Now this data is from KPMG. They've also found that the TPD claims followed with the highest being a mental health claim at 25%. So you can see that the cancer and the mental health is one of their bigger focuses at the moment. And also, once again, in income protection and disability income, they've also had cancer being the highest cause at 58%. Now, the reason why I was mentioning those two things is once you do have, the only problem with insurance is great. If you can get in when you're nice and fit and don't have too many issues, it's not an issue to pick up cover. If you leave it too long potentially, and you start to pick up an illness or you've had a couple of injuries, the insurers start to look at you less favourably on their books as to be at a higher risk at making a claim. So it becomes harder to actually get in and get yourself a policy. That's the one thing I would just warn in regards to ever taking out cover. Just keep in mind they will judge you on any sort of prior health issues and hereditary problems. Generally, they won't want to see more than 3 or 4 problems at worst before they just give you out a straight up decline. So it's something worth having a chat to an advisor about. If you do have something that would be of concern or potentially something that may just hold you up getting that sort of cover, we can work through and find potentially a different holder that might have a different view or appetite depending on what they've got on with them. So that's just one thing I find that's quite important just to keep in mind when you do want to source insurance cover. Don't keep pushing it back forever because it may be too late at that point. Another claims data I was add in from the year before, also got the severe stress, depressive episodes, anxiety, bipolar, and use of alcohol. These are all increasing and will be progressively be looked at more and more by the underwriting teams with the insurers. So just keep those in mind. If that's something that is of relevance to yourself,
has been spoken about with the doctors. The insurers will have access to that information, and we want to ask them further questions just to make sure that they're not taking on someone who's just, so to speak, was going to take out the cover just to make a claim straight off the bat. Now, with the insurance, you've got to keep in mind it's never a forgetting, set and forget. Now, as your career progresses and income will increase, we just recommend you guys to regularly review your cover and ensure it meets your needs. For example, we've seen a doctor who's taken out a policy early in their career when their earnings were roughly 80K. Now, they didn't review it, and over the years it's increased due to inflation, coming up to about 95,000 per annum. Now, 6 years later, that income was actually closer to 200,000. And unfortunately, that year they've had a medical event which caused them to never be able to work again. So, in doing so and not reviewing the cover, they're actually stuck at receiving 75% of a $95,000 salary, whereas they could have had it reviewed and they would have been closer to $16,600 a month, where they could have been receiving. Now, to review the cover, it's a way also that you can reduce costs over time. As family gets older, the kids go through school, you'll be paying off all the debt, and there won't be as need for all that cover. The insurers won't tell you this. They'll just be letting you happy to renew and let the premiums bounce forever until they're ready to make a claim. Our role here is just to make sure that you're not going over any amount needed, and we can price in exactly where you need to be for what type of money. So you're not going to be paying for cover that's not needed. Now, if you currently have an advisor, this is part of their role. They should be actively contacting you every year upon the renewal to ensure that your details are up to date, all that sort of admin, make sure you're getting the paperwork, but mainly to see if you're adequately protected and that you've got the right level of sum assured and you're not overpaying the insurers. Now, if anyone needs any help, just to have a look through their cover or just wants to get an idea if they've got the same thing, feel free to get in contact. I'm more than happy to help you out in that regards. Now, that's pretty much most of it for myself. If there's any other questions in regards to the income protection, just let me know. And
I think we're all good. Any questions, guys?
No.
And if you do, feel free to give me an email or call at any stage, happy to help.
Thank you.
Thank you so much, guys.
Fantastic. Thanks, guys.
Oh, sure.
Thanks, Chris and David. Have a good one.
Thank you. See you guys. Bye.
Bye.
Nice.
Cheers. Sorry, the thing wasn't working
Thanks,
at the beginning.
Thanks for getting touch.
Yeah, that was